Imagine you are driving down the highway, right? You're on this massive cross-country road trip, and you look down at your dashboard, and the whole thing is just flashing red.
Like a complete nightmare scenario.
Exactly. I mean, the fuel gauge says empty, the check engine light is blinking aggressively, and your GPS is literally telling you that there's this massive storm ahead.
Right, so you should definitely be pulling over.
Yeah. By all accounts, you should be pulling over to the side of the road, putting your hazard lights on, and just calling for a tow truck.
Which is the logical thing to do.
Right. But somehow, despite all those blaring warning lights, your car is actually accelerating.
Accelerating.
Yeah, accelerating. And your fuel efficiency has hit an all-time high, and you are making record time.
That makes absolutely no sense on the surface.
It makes zero sense. But, that exact paradox is playing out right now in the Q2 2026 earnings report for LCI Industries. Ticker symbol, LCII. Welcome to Talk Tickers, by the way. Today's deep dive is all about breaking down this massive earnings paradox for you, the retail investor.
And it is quite a paradox. I mean, the dashboard for the entire recreational vehicle industry, the RV industry, has been flashing red for a while now.
Oh yeah, big time.
We are talking about a prolonged, really painful slump across the entire RV supply chain. It's not just a little dip.
No, it's a huge slump. And you add to that the fact that LCI is navigating this major leadership transition, right?
Right, they have an interim CEO right now, John Serpilla, at the helm.
Yeah, John Serpilla. And, on top of the macro stuff and the CEO transition, they are basically sitting in the waiting room for a massive pending merger with Patrick Industries.
Exactly. So it is a highly, highly complex setup for the company.
Right.
You have these macroeconomic headwinds, you've got structural shifts for the post-COVID era, and massive corporate restructuring all happening simultaneously.
Which is why our mission for this deep dive is to sort of separate the noise, the accounting adjustments and all that from the true underlying operational health of this company. Because I was looking at their headline numbers, and I have to tell you, the discrepancy between what they are officially reporting and how the business is actually operating.
Jarring.
Jarring is the word. It gave me a genuine case of whiplash.
I'm not surprised.
Let's look at the top line first. So their adjusted net sales came in at $1.1 billion.
Okay, $1.1 billion.
Right. And that is a 4% decrease year over year.
Which is, not great.
Not great, but totally understandable given the RV slump we just talked about.
Sure.
But then you look at that GAAP net sales, the official, heavily regulated accounting standard revenue.
The number most people see first.
Exactly. And that was only $969 million.
Wow.
Yeah, that is a 13% decline. So there is a roughly $89 million gap right there just sitting between their adjusted sales and their official GAAP sales.
It's a massive hole.
Right. And if I'm an investor, and I'm just running an automated stock screener and I just see a 13% revenue drop.
You're panicked.
I'm probably running for the hills. I mean, I'm selling immediately.
And see, that is precisely why relying purely on automated stock screeners can lead you completely astray in a quarter like this.
Yeah, you have to look under the hood.
Exactly. That $89 million difference is a textbook example of why accounting reality and operational reality sometimes just diverge completely.
So translate that for us. What is that $89 million?
Well, the gap is entirely due to IEPA tariff refunds.
IEPA.
Yeah, IEPA. It stands for the International Emergency Economic Powers Act.
Okay. Sounds intense.
It does. And the mechanics of this are actually fascinating without, turning this deep dive into a trade law seminar.
Please don't.
I won't, I promise. But basically, LCI's finance and procurement teams essentially conducted this massive internal audit.
Okay, an audit of their own expenses.
Right. And they realized they had actually overpaid on tariffs tied to very specific imported materials.
Oh, wow. Over a long period.
Yeah, over a prolonged period. So they compiled all these eligible claims and aggressively went after the federal government to get that money back.
Getting $89 million back from the government?
It's a huge win.
I mean, that is a massive victory for any procurement team anywhere.
Absolutely.
But I read the transcript from the earnings call, and here is where I almost did a double take.
You didn't keep it.
They didn't keep the money.
No, they didn't.
I mean, instead of letting that $89 million just fall right to their own bottom line, which would make their quarter look artificially amazing. Right?
Oh, it would have massively inflated their numbers.
And secured all the management bonuses.
Naturally.
But instead, they passed it directly back to their customers.
Every single penny.
The original equipment manufacturers, the OEMs, who buy their parts to build the RVs.
Yeah. They essentially acted as a highly aggressive, pro bono, tax recovery service for their own customers.
That is wild.
It is. But under generally accepted accounting principles GAAP, they are legally required to record that massive outbound refund as a reduction in their net sales for the current quarter.
Ah, okay. So that is what dragged the official GAAP revenue down by 13%?
Exactly. The accounting rules treat it as negative revenue. But in practical cash flow terms, it's merely a pass-through.
So the cash comes in from the government.
And the cash goes right out the door to the OEMs.
Got it.
So it has virtually zero impact on LCI's actual profit and loss statement for their ongoing operations.
Okay, I see the logic in buying goodwill, but let's pause and unpack this.
Sure.
Handing over $89 million when your own underlying adjusted revenues are already down 4%. That seems like a massive gamble.
It's definitely a bold move.
Because we are talking about a highly competitive supplier environment here. How do we know these OEMs, these big manufacturers, won't just take the refund, say thank you very much, and still switch to a cheaper supplier next year?
That's the risk, right?
Right. And why dedicate your own internal resources to do this? Because the CEO explicitly mentioned on the call that they did this entirely internally to avoid paying third-party contingency fees.
Which would have taken a huge cut of the refund.
Exactly. So they did all that heavy lifting, burned all those man hours just to give the cash away.
Well, it comes down to the game theory of supplier and OEM relations, especially during a cyclical downturn.
Okay, explain that.
So the RV market is incredibly soft right now, as we've established.
Very soft.
The manufacturers, right, companies like Thor Industries or Winnebago, they are hurting. Their margins are heavily compressed, their dealer lots are completely full of inventory, and they are frankly desperate for cash flow.
Right. Nobody is buying RVs at 8% interest rates.
Exactly. So by handing over nearly $90 million to these partners at the exact moment they need it most, LCI is creating a structural dependency that is built on trust.
Oh, I see.
It is a very calculated bet.
So you're saying when the market inevitably recovers and OEMs finally ramp up production again,
the procurement officers at those companies are going to remember perfectly well who squeezed them for every penny during the winter and who fought the federal government to hand them a $90 million lifeline.
Wow. Okay. So LCI is basically securing future market share by forfeiting a one-time cash windfall today.
Precisely. It's a long-term play.
Okay. That reframes that entire 13% revenue drop for me.
It changes the whole narrative.
It really does. But, the top line is only half the story here.
Oh, absolutely. The bottom line is even more interesting.
Yeah. The profit metrics are where the math gets genuinely confusing for a retail investor.
Let's break it down.
So they posted a 4% drop in adjusted sales, right? Meaning literally less money is coming through the front door.
Correct. Revenue is down.
Yet their adjusted diluted earnings per share, the actual profit generated for each individual share of stock, jumped 13%.
Up to $2.70.
Right. Up from $2.39 last year. That's a huge jump.
It is.
And furthermore, their adjusted operating profit margin actually expanded by a little over 1%, specifically 110 basis points, reaching 9.3%.
Yes.
So I just have to ask, how does a manufacturing company that makes heavy physical goods manage to post falling sales while their profits and their margins both shoot up?
It's a great question. And it requires a fundamental redesign of how the company operates.
What do you mean by redesign?
Well, you can't achieve those kinds of margin expansions on falling volume just by, cutting the corporate travel budget or freezing new hiring.
Right. You can't just skip the holiday party and save that much money.
Exactly. Management has to alter the structural break-even point of the entire enterprise.
Okay.
In the earnings call, interim CEO John Serpilla referred to this as their self-help initiatives.
Self-help. I like that.
Yeah. They recognized really early on that they couldn't control the macroeconomic weather. Right? They can't control interest rates, consumer confidence, or inflation.
Nobody can.
So instead, they focus entirely on weatherproofing their own house.
I was looking at the specifics of that weatherproofing in the data, and honestly, it is severe.
It's aggressive.
Extremely aggressive. They closed 5 facilities last year just to consolidate their footprint.
Right.
And then they announced on this exact call that they are planning to close another 8 to 10 facilities in the back half of 2026.
Yes, they are not slowing down.
But wait, closing 13 to 15 manufacturing and distribution centers in just a 2-year window? That isn't just trimming the fat.
That is major surgery.
That sounds like amputating limbs. How does a company close that many actual physical factories without completely losing the capacity to build and deliver parts when demand eventually returns?
And that is the critical distinction we have to make here between panic cutting and strategic consolidation.
Okay, tell me the difference.
The mechanics of these closures rely on something called manufacturing absorption.
Manufacturing absorption.
Yes. So think back to the massive COVID-era boom.
Everyone bought an RV.
Everyone, LCI, like everyone else in the industry, expanded incredibly rapidly.
They had to, right? Just to keep up.
Exactly. They leased or bought facilities everywhere just to keep up the sheer volume of orders rolling in.
Right.
But as demand normalized post-COVID, they were left with this highly fragmented footprint. They had multiple factories running at maybe 60 or 70% capacity.
Because the order volume dropped.
Right. So by closing those redundant facilities now, they aren't actually abandoning the capability to make those products.
They aren't.
No, they're physically moving the assembly lines, the tooling, the machinery into their larger mega facilities.
I see. So they're essentially taking, let's say, 3 different factories that are all running at 60% capacity.
Right.
And they're consolidating them into 2 factories that run at 90% capacity.
Precisely. And when you do that, you eliminate the duplicate rent.
Right, few releases.
You eliminate the duplicate middle management, the redundant utility bills, the split logistics chains.
The savings stack up fast.
Very fast.
Yeah.
You maximize the output per square foot of your remaining real estate.
That makes total sense.
And alongside that, they are aggressively reshoring their product procurement as well.
Reshoring, meaning bringing it back from overseas.
Yes. By sourcing components much closer to home, they avoid the very tariffs we discussed earlier, while simultaneously drastically lowering their inbound freight costs.
Shipping massive metal parts across the ocean cannot be cheap.
It's incredibly expensive. So these are permanent structural cost reductions. They have fundamentally lowered the sheer amount of revenue required just to keep the factory lights on.
And that exact operating leverage shows up vividly in their OEM segment numbers.
It really does.
I have the numbers right here. Their OEM net sales dropped 20% to $674.8 million.
A huge drop.
Yeah, and the core driver there is that wholesale shipments of towable RVs.
Right.
You know, the actual trailers you hitch to the back of a pickup truck.
Right.
That volume dropped 20% across the entire industry.
So unit volume is down a full fifth.
Exactly, down a fifth. But despite taking a 20% hit to sheer volume, LCI's OEM adjusted operating margin actually expanded a full percentage point to 7.5%.
And that margin expansion right there on a 20% volume drop is the direct mathematical result of the facility consolidation we just talked about.
It's the proof that the strategy works.
Exactly. The fixed costs were lowered so dramatically that the remaining revenue, even though the pie was smaller, generated a higher percentage of pure profit.
But, you know, reading the transcript, there is another mechanism at play here that protected their revenue from falling even further.
Yes, there is.
Because while the overall industry built 20% fewer RVs, LCI ensured they were making significantly more money on the ones that were actually being built.
Right. They maximize the value of every single unit.
Which brings us to the content per unit, or CPU.
A crucial metric for LCI.
Really crucial. So for towable RVs, LCI's CPU hit $5,831.
Over $5,000 a unit.
Yeah, and that is an 11% increase year over year. Let's break down the mechanics of this, because I think, you know, regular retail investors hear content per unit, and they just naturally assume it means inflation.
Right. They think it just means charging more money for the exact same stuff.
Exactly. Like shrinkflation or something.
But it is entirely distinct from inflation.
Okay, explain what CPU actually measures.
Content per unit literally measures the total dollar value of LCI manufactured components physically inside a single RV rolling off the OEM assembly line.
Okay, so if I go to a dealership and buy a travel trailer today.
LCI likely manufactured the steel chassis it sits on.
Right.
They manufactured the axles, the motorized slide-outs that expand the living room, the windows, the interior furniture, and probably the air conditioning unit on the roof.
Wow, they are practically building the whole thing.
They supply a massive portion of it. So CPU of $5,831 means that, on average, LCI is capturing nearly $6,000 of pure value from every single towable RV built by their customers.
That is incredible penetration. So it's not like the shrinking pie analogy where they are just forcefully taking a bigger slice of a smaller pie.
No, it's different.
It's more like Think of the housing market.
Okay.
Home builders might be constructing 20% fewer houses because of high interest rates, right?
Yes, sure.
But LCI realized they can offset that lost volume by ensuring that every house they do build is a fully furnished, high-end smart home instead of just a basic empty shell.
That is a perfect analogy.
So they are compensating for the lack of quantity with a massive increase in actual upgrades.
That is the exact mechanism. They are aggressively pushing premiumization and innovation into the market.
And they have the numbers to back that up.
They do. Management highlighted a $270 million normalized annual run rate, stemming entirely from their top 5 new product innovations.
$270 million just from new stuff.
Right. They aren't just stamping out basic metal frames anymore. They are integrating highly complex, high-tech, high-margin systems.
Yeah, I was tracking those specific products in the source material we got for this deep dive.
Oh, what stood out to you?
Well, we are talking about things like the Furry and Chill air conditioning system.
Right, a huge upgrade.
High-end power biminis for their marine applications, for boats.
Very high margin.
Upgraded residential-style furniture, and these advanced automated leveling systems so you don't have to manually crank your RV any further.
People love those.
Right. And they even noted on the call that the broader industry is currently seeing a big shift toward entry-level single-axle trailers.
Which normally hurts a supplier.
Exactly, because those budget models typically have far less content. Budget-conscious consumers are skipping the bells and whistles.
Right, they just want the cheapest camper possible.
Yet, despite the whole market shifting toward cheaper trailers, LCI still managed to drive their overall CPU up by 11%.
Which demonstrates immense pricing power and market penetration. They have made their advanced systems so standard, or at least so highly desirable, that even entry-level buyers are actively opting for them.
Or the OEMs are just forcing them into the base models just to remain competitive on the dealer lot.
Exactly. And this isn't just a trailing, backward-looking metric either.
What do you mean?
Looking ahead, they disclosed that they already have $140 million in annualized revenue locked in for new product placement.
Locked in already?
Yes, specifically on the upcoming 2027 model year RVs.
Wow.
They are embedding their growth directly into the future blueprints of their customers.
Okay, I hear you, but I have to push back on the profitability of this specific strategy.
Go for it.
We are talking about manufacturing highly complex physical goods here. Metal, plastic, copper, wiring.
Very material intensive.
In the earnings transcript, the CFO, Lillian Etzkorn, explicitly stated that aluminum prices were up 80% year over year.
It's a massive spike.
And steel prices were up 20%.
Right.
80% on aluminum. How in the world are they not getting absolutely crushed on material costs?
That's a very fair question.
If the primary raw ingredient for your chassis and your awnings nearly doubles in price in a year, your margins should be imploding, not expanding. You can't just innovate your way out of an 80% commodity spike.
You are absolutely correct. Innovation alone cannot offset raw commodity spikes of that magnitude.
So how are they doing it?
The primary defense mechanism LCI uses here is structural contractual index pricing.
Index pricing. Okay, break that down for us.
Sure. In their OEM business, where they sell these massive components directly to the manufacturers, they do not negotiate a fixed price for a window or a chassis for the entire calendar year.
They don't just say, this window is $100 all year.
Exactly. Because if they did, they would just have to pray that commodity costs remain stable.
Which they never do.
Right. Instead, their supply contracts are legally tied to specific global commodity indices.
So when the global spot price of aluminum jumps 80%?
LCI doesn't have to eat that cost.
Right. They just update the invoice.
Yes. They pass that exact 80% material hike directly along to the OEM.
But wait, OEMs aren't stupid.
No, they are highly sophisticated.
They have their own margins to protect. If I'm Thor Industries, I'm going to fight back tooth and nail against an 80% surcharge on my parts.
Of course you would.
How does LCI actually enforce this without just completely losing the contract to a competitor?
They enforce it through sheer market dominance and absolute transparency.
Meaning they are too big to replace?
Largely, yes.
Yeah.
LCI controls such a massive percentage of the RV supply chain that an OEM cannot simply, easily source 50,000 motorized slide outs from a competitor on a whim.
The logistics of that would be a nightmare.
The switching costs are astronomically high. But more importantly, the CFO made a very specific point to clarify how they manage this power.
What did she say?
She stated they do not engage in opportunistic pricing.
Meaning they aren't using the aluminum spike as a convenient excuse to pad their own margins.
Yeah.
They aren't passing along a 90% hike when costs only went up 80%.
Right. They aren't skimming off the top. When steel and aluminum go up, they pass the exact cost through down to the actual penny.
I see.
And conversely, she noted that a few years ago, when those commodities crashed and prices plummeted.
Let me guess. LCI passed those savings directly back to the OEM.
They did.
Yeah.
It is a completely transparent mechanical relationship.
Okay, so this index pricing fundamentally insulates LCI's profit margins from all the wild, unpredictable swings in the global commodities market.
It does. They aren't in the business of speculating on metal prices.
Leave that to the commodities traders.
Exactly. They are in the business of manufacturing value-added components.
Okay, the mechanics of index pricing make perfect sense for the OEM side of the business.
It's very clean.
You have two massive corporations signing these complex multi-year index contracts, but, that only covers the wholesale side. Let's talk about the other side of LCI's business.
The aftermarket.
The aftermarket. Because the sources show that aftermarket net sales grew 11% to $294 million.
It was a very strong quarter for them.
And their adjusted operating margin in the aftermarket is a staggering 14%.
Almost double the OEM margin.
Exactly. But here's the thing. You can't just slap a complex index pricing surcharge on a regular retail customer who walks into a dealership looking to buy a replacement awning.
No, you absolutely cannot.
How are they protecting a 14% margin against 80% aluminum hikes when they're selling to regular, everyday consumers?
You hit on the exact vulnerability of the aftermarket model right there. You cannot pass commodity spikes directly to the retail consumer without completely destroying demand.
They would just walk out of the store.
Right. So to protect that 14% margin in the aftermarket, LCI has to rely entirely on internal supply chain execution.
Back to the self-help.
Exactly. This is where those reshoring efforts and distribution center optimizations we discussed earlier pay massive dividends.
So they are offsetting the higher cost of aluminum.
By finding significantly cheaper freight routes.
Oh, I see.
By negotiating much better warehousing terms and optimizing their inventory management so they aren't paying to store parts they simply don't need yet.
Squeezing the juice out of the logistics to protect the retail price.
Exactly.
But, the real story in the aftermarket isn't just how they are defending the margin. It is the sheer volume of incoming demand.
The demand curve is fascinating right now.
We have to talk about the COVID boom echo because looking at the data, this feels like the hidden engine that could power this entire company for the next half decade.
It is the most compelling part of their story.
Let's ground this in reality for the listener. During the pandemic, it seemed like everyone's neighbor impulsively bought a travel trailer.
Because it was the only way to go on vacation safely.
Right. You couldn't fly, hotels were closed, so everyone bought an RV.
Millions of them.
And those trailers have basically been sitting in driveways, baking in the sun, or getting rattled down dirt roads for the last 3 to 5 years.
And the wear and tear reality of an RV is significant.
Oh, it's huge.
It is essentially a lightweight house experiencing a continuous earthquake while rolling down the highway at 70 miles an hour.
Things are going to break.
Things break constantly. And the CFO actually quantified this impending wave with a very specific metric on the call.
What was the number?
She identified that approximately 1.5 million RVs are moving into their prime repair cycles over the next several years.
1.5 million units.
Yes.
And because LCI has over $15 billion worth of replaceable content out in the field from the last decade of manufacturing,
They own the installed base.
when those 1.5 million COVID-era RVs finally go into the shop because, say, a water pump failed or a slide-out motor burned out or the awning just tore,
They're almost certainly buying LCI replacement parts.
it is the classic razor and razor blade business model, but scaled up to vehicular proportions.
Exactly.
You sell the OEM the initial part at a 7.5% margin to build the RV.
And then 5 years later, you sell the exact same replacement part at a 14% margin when it inevitably breaks. And the aftermarket dynamic extends way beyond simple repairs, too. It actually encompasses upgrades.
Upgrades, like customizing it.
Yeah. CEO John Serpilla detailed how consumers who actively use their coaches don't just fix what is broken, They actively improve the unit.
Oh, that makes sense.
Someone who bought an entry-level trailer back in 2021 might now want a much more powerful AC unit for summer camping in Texas.
Right.
Or maybe they're tired of manually cranking the leveling jacks in the rain and they want to install an automated system.
So they buy the LCI upgrade kit.
Exactly. That persistent upgrade cycle is what drove that 11% growth in the aftermarket this quarter.
It provides this massive high-margin revenue cushion.
It does. It directly offsets the cyclical macroeconomic downturn in new RV sales.
So looking backward at Q2, the execution here is just highly impressive.
It's hard to fault them.
Right. I mean, they navigated the IEPA tariff refunds to build long-term OEM goodwill. They consolidated facilities to fundamentally alter their break-even point. They forced growth through innovation to increase their content per unit. And now they're successfully surfing this massive high-margin aftermarket repair wave.
They checked all the boxes.
But you and I both know the stock market is aggressively forward-looking.
Always.
Investors do not buy a stock for what the company achieved yesterday. They buy it for what the cash flows will look like tomorrow.
Which brings us to guidance.
Exactly. Let's examine management's updated guidance for the rest of 2026, because this is where the financial engineering really gets put to the test.
The updated guidance provided by management is perhaps the most revealing part of this entire earnings call.
How so?
It basically functions as the ultimate proof of concept for everything we have discussed so far.
Okay, break down the numbers.
They began by actually lowering their macroeconomic forecast.
So they admitted things are getting worse.
Yes. They reduced their expectation for full-year RV industry wholesale shipments. They brought the range down from 315,000 to 330,000 units, down to 280,000 to 300,000 units.
Okay, so they are looking at the realities of the consumer, stubborn inflation, high interest rates, making financing extremely difficult.
Right.
And they're just admitting that industry-wide demand is going to remain soft.
They are being realistic.
And as a direct result of that downgraded industry forecast, they also lowered their own full-year revenue guidance.
It had to.
They are now projecting $3.9 billion to $4.1 billion for the year.
Which is a haircut of roughly $250 million from their previous top-line expectation.
$250 million gone.
Yes. And this is where the mechanics of corporate finance usually dictate a very specific, painful outcome.
Margin collapse.
Exactly. Typically, when a manufacturing company tells Wall Street they're going to generate $250 million less in revenue than initially projected, their profit margin guidance completely collapses.
Because the fixed costs remain exactly the same, but the revenue drops, totally destroying the operating leverage.
That is the standard script.
But that isn't what happened here. This is where I almost dropped the transcript while reading it.
It's the flex of the century.
It really is. Despite wiping $250 million off their expected top-line revenue, LCI maintained their full-year operating margin guidance.
Right, at 7.5% to 8.0%.
How is that mathematically possible? If you lose $250 million in sales, how do you not lose a single basis point of margin expectation?
It is entirely possible because the cost cuts they executed over the last 18 months were structural, not superficial.
Back to the facility closures.
Yes. When the CFO was challenged on this exact point by an analyst during the Q&A portion of the call, she literally provided the math.
What did she say?
She noted that their facility consolidations and supply chain improvements have already yielded 160 basis points of permanent structural margin improvement.
Wow. 160 basis points permanently baked in.
Exactly. They essentially removed the fixed costs from the equation before the revenue drop even occurred.
They redesigned the engine to run optimally on way less fuel.
That is exactly why they can absorb a $250 million revenue hit and still maintain the 7.5 to 8% margin.
Which leaves their full-year adjusted EPS guidance sitting at a very healthy $8.25 to $8.75 per share.
It's incredibly resilient.
But, I have to play devil's advocate here.
Please do.
If management is cutting costs that aggressively closing 13 to 15 facilities, slashing overhead, terminating leases, are they cutting into the bone?
It's a valid concern.
Because it is a classic Wall Street trap, right? A management team starves the company of vital capital expenditures just to make the margins look resilient for the current quarter.
To save their own jobs.
Right. But in doing so, they completely cripple the company's ability to grow when the macro environment finally recovers.
You see it all the time.
How do we know LCI isn't just mortgaging their future to save their present?
That is the primary risk factor investors must evaluate during any major corporate restructuring.
So what does the data say here?
Well, LCI's capital allocation data strongly suggests they're actually playing offense, not just defense.
Offense.
They are not hoarding cash or freezing investments. They spent $19 million on capital expenditures in Q2 alone.
Okay, that's not zero.
And they reaffirmed they are completely on track to deploy $55 million to $65 million for the full year.
And what are they actually spending that money on? Because a significant portion of that capital is being deployed to a brand new facility in Texas, right?
Yes, specifically dedicated to the Ranchan brand.
For those who aren't familiar, Ranchan operates in the automotive aftermarket space. They manufacture those massive heavy-duty truck bumpers, grille guards, and vehicle armor.
Right. And this new Texas facility is explicitly being built to double their manufacturing capacity for those specific products.
Double it. Okay, a management team does not double the production capacity of a physical manufacturing plant if they're simply playing defense and starving the company of capital.
Absolutely not. They clearly see a massive growth runway in the automotive aftermarket and are aggressively deploying capital to capture it right now.
That does point to a healthy long-term view.
Furthermore, their balance sheet metrics validate this aggressive posture.
What's the liquidity look like?
They are sitting on $812 million in total liquidity.
$812 million. That's a huge safety net.
It is. That is comprised of $217 million in actual cash and almost $600 million available on their revolving credit facility.
And crucially, their leverage profile is incredibly conservative for a manufacturer. Their net debt to adjusted EBIT ratio is sitting at just 1.5x.
Which is very low.
They actually paid down debt during the quarter, improving that ratio from 1.8x at the start of the year.
Right, they're deleveraging while still investing.
So just to summarize this setup, they have the cash on hand to invest.
Yeah.
They are actively building new capacity for high-growth automotive brands.
Correct.
They have minimal debt servicing pressure.
Right.
And they are closing redundant RV facilities to keep their overall margins historically high.
It paints a picture of a management team operating with a very, very high degree of capital efficiency.
It really does. But we also have to address the giant elephant in the room regarding capital allocation.
The pending all-stock merger with Patrick Industries.
We have to talk about it because LCI is currently in a regulatory quiet period, right? So management was legally constrained in what they could actually discuss on the call.
They couldn't say much.
But CEO Jean Serpilla did reiterate the core strategic rationale.
Which is what?
The goal of the merger is to basically create a broader, more innovative product platform to cost-effectively bring more products to the outdoor recreation consumer.
Which is corporate speak for building a massive monopoly.
Pretty much. I mean, if we look at the mechanics of that merger, assuming it clears regulatory hurdles, it fundamentally alters the landscape of this entire industry.
It changes everything.
Patrick Industries is another massive supplier in this space. Combining LCI and Patrick creates an absolute behemoth in the outdoor recreation supply chain.
It's unprecedented scale.
You are looking at a near monopoly on the internal components that go into both RVs and marine crafts.
The pricing power would be insane.
The economies of scale they could achieve by integrating those two supply chains together would just be staggering.
Now, the antitrust considerations will be complex, obviously.
Definitely. The regulators will look very closely at this.
But if finalized, the combined entity would possess unprecedented leverage in negotiating with both OEMs and raw material suppliers. It is the ultimate long-term catalyst sitting on the horizon for LCI.
Okay, we have dissected the accounting adjustments, the operational restructuring, the margin defense mechanics, the aftermarket dynamics, and the capital allocation strategy.
We covered a lot of ground.
Let's bring this all together for the retail investor listening right now.
Okay, the bottom line.
Yeah. If we synthesize all this data, what is the bottom line? How should an investor interpret this specific moment in LCI's corporate trajectory?
Synthesizing the data, the objective stance is decidedly bullish on LCI's management execution.
Bullish on the management.
Very bullish, but necessarily cautious regarding the immediate macroeconomic environment.
Because the macro still looks rough.
The RV industry remains firmly in a winter cycle. Interest rates are high, consumer savings are depleted, and frankly, financing a $60,000 travel trailer is currently unfeasible for a large portion of the middle class.
The math just doesn't work for the consumer right now.
It doesn't. The macro headwinds are real, and they are quantified by management's downgraded revenue guidance.
Right.
However, LCI is proving to be the best-in-class house in a currently stormy neighborhood.
I love that phrasing.
They have weatherproofed their operations so effectively through that facility consolidation and the aftermarket expansion that they are generating incredible cash flow and expanding margins at the very bottom of the industry cycle.
So, if you are a current shareholder, right, you're holding LCI stock in your portfolio today. What does the data suggest is the most logical action for you?
For current holders, the fundamental data suggests holding tight and just letting the strategy play out.
Hold and wait.
Exactly. You are essentially being paid to wait out this macroeconomic winter.
Because of the dividend?
Yes. LCI maintained their dividend at $1.15 per share for the quarter.
And at current valuations, that translates to a very attractive 4.3% dividend yield.
Which is a solid return just for holding.
Yeah. You can collect that 4.3% yield while management continues to squeeze operational efficiencies out of the business, and you just wait for the Patrick Industries merger to either finalize or fall through.
And the downside risk appears significantly mitigated by their low 1.5x debt leverage and that massive liquidity position we discussed.
Okay, so that's for current holders, but what if you are a potential buyer?
Looking for an entry point?
Right. What if you are sitting on the sidelines looking at LCI's structural improvements and trying to identify the optimal entry point before the market prices and the eventual recovery?
For potential buyers analyzing the entry point, the single most important metric to monitor is dealer inventory levels.
Dealer inventory.
Okay. On the call, management provided specific insight into this. They noted that currently, dealerships across the country are sitting on about 18 to 20 weeks of inventory on their lots.
18 to 20 weeks. And they categorize that 18 to 20 week level as responsible for this specific point in the selling season.
Responsible is the key word there.
Right. It means the dealers aren't completely choked with excess product that they have to heavily discount and take losses on.
But they aren't desperate for new units either.
Exactly. They are in a stable holding pattern, just waiting for consumer demand to dictate their next move.
Precisely. And the trigger event that will likely ignite LCI's stock price.
The catalyst.
Yes, the catalyst is the moment. Retail sales, meaning actual consumers buying RVs off the dealership lots, begin to consistently outpace the wholesale shipments coming from the factories.
So the moment the Federal Reserve drops interest rates enough to actually spark consumer financing again,
those dealers will burn through that 18-week inventory incredibly quickly.
because the pent-up demand is there.
Exactly. And when those lots empty out, the dealers will have to place massive reorders with the OEMs.
Which means the OEMs will immediately ramp up production and flood LCI with component orders.
The floodgates open.
And because LCI has fundamentally lowered their break-even costs by closing 15 facilities, and they've baked in those 160 basis points of permanent margin improvement.
Their operating leverage will kick in violently.
Violently is right. Every new dollar of revenue from that recovery will completely bypass the fixed costs and fall straight to the bottom line.
The earnings expansion and recovery scenario could be explosive.
It's like a coiled spring. They have pushed their cost structure down so far that when the macroeconomic weight is finally lifted, the profitability is going to bounce back incredibly hard.
That is the core bull thesis for the stock. But there is one final, highly counterintuitive dynamic that investors really need to consider.
Okay, lay it on us.
It wasn't explicitly outlined as a formal strategy in the earnings call.
But the data implies it.
It is heavily implied by the data surrounding the aftermarket segment we discussed.
I know exactly what you were pointing toward, and this is where the mechanics of the RV market get truly fascinating.
It's a bit of a paradox.
We talked extensively about the 1.5 million COVID-era RVs that are currently hitting their prime repair and upgrade cycles.
Right.
The baseline assumption is that this is just a natural, predictable wear and tear cycle that will provide a steady stream of revenue.
A nice bonus for LCI.
Right. But we have to factor in the macroeconomic environment. Inflation has completely squeezed household budgets.
We are operating in an environment of severely constrained affordability.
If the economy weakens further, or if interest rates just remain stubbornly high for the next 3 years, what does an average family do when the slide-out motor on their 2021 travel trailer burns out?
Well, in a booming economy with low interest rates, the friction to just upgrade is minimal.
Right. If your 5-year-old RV starts having expensive mechanical issues, the tendency is to simply trade it in.
You roll the negative equity into a new loan and finance a brand new, highly contented 2027 model.
And that behavior drives the OEM side of LCI's business.
Exactly.
But in a tight economy, that math completely falls apart.
You cannot afford the 8% or 9% interest rate on a new $70,000 rig.
Your household budget simply won't allow it. You are financially trapped.
So you're forced to fix the old one.
Exactly. You opt for the $2,000 aftermarket repair instead of the $70,000 wholesale replacement.
Which means a deteriorating macroeconomic environment, while undeniably terrible for LCI's wholesale OEM business.
It actually acts as a massive supercharger for their high-margin aftermarket business.
Financial constraint literally forces families to repair, maintain, and incrementally upgrade their existing rigs just to extend their usable lifespan.
And because LCI captures a 14% margin on those aftermarket parts compared to a 7.5% margin on the OEM parts.
A shift in consumer behavior toward repair rather than replacement could actually drive overall profitability higher.
Even as top-line industry unit sales completely stagnate.
It's a built-in hedge against a bad economy.
It's brilliant. So we started this analysis talking about a car with a flashing check engine light that is somehow accelerating and getting better gas mileage.
The ultimate paradox.
The entire RV industry is flashing red, the macro economy is flashing red, but because of LCI's aggressive internal facility consolidation,
there's sheer pricing power on content per unit.
There's strategic goodwill with OEMs and this massive looming wave of high-margin aftermarket repairs.
It changes the whole picture.
It raises a deeply provocative question for anyone analyzing this stock. Could a bad economy actually be LCI's secret weapon?
The data suggests it just might be.
That gives you plenty to mull over as you look at your own portfolio this week.
It certainly does.
We will catch you on the next deep dive.